Class. Do we have a coffee class branded thing here? We have nothing to prove. I'm at the coffee class. Oh yeah, coffee class. There you go. Coffee class. Here with Carissa.
Hi, I'm Carissa.
Carissa is I don't know why you're off camera. You should be on camera. No one wants to see me. Carissa is our my protege. She's a realtor, new realtor. So she's getting to learn the new market that we're in, which is fun. And for me, it's 20 years almost in real estate. So I've been through some ups and downs. But this is a different kind of market. So we're going to talk today about how to defeat high interest rates. And there's a lot of different ways you can do it, and we are going to do that. It's our first time using this platform to do it. So I would not like to say ask your questions, but I have no earthly idea if you can. So ask your questions, and we will answer them on our next episode. All right, so let's talk about this. So Carissa, why don't you ask some questions? You're in the market. Your buyers are looking for different things. Ask us some questions. So I don't do all the talking.
Okay. So I think the most common question I get is, do you think interest rates are going to go up or go down?
Interest rates are going down. They've already started going down. Actually, it's funny. Like you watch the news, and when they go up, it's like the end of the world. But they've actually gone down noticeably in the last month or so. And so I think they'll probably go down some more next year, just based on the economy. Usually, when the economy starts to people have worries about the economy, you see rates tend to come down, and so we may see lower interest rates in 2023. It's still not going to be what we've had the last 15 years. Obviously, like the 3-4% rates are probably not coming back for a long time, but rates will be lower. Now, the other thing is interest rates are high. First thing about interest rates are higher than they have been. However, prices are lower. They've dropped about 20%, really, in reality. And so, a year ago, if you bought a house, you would have to pay $30,000, $40,000 over appraisal to buy a house, cash out of pocket. And right now, you can buy a house and get the seller to actually pay your closing costs, and you can buy down your interest rate. So it's not as big a gap as it seems, because the market is much more buyer friendly right now than it has been. What else you got?
Okay. What about introducing seller financing?
All right, so seller financing. So one way to defeat high interest rates is to purchase a property where the seller has either no mortgage or they have a low mortgage, and the seller is struggling to sell it because it's a slow market. So you as a buyer could come in and say, okay, why don't you as a seller carry back the mortgage? I'll give you, let's say 20% down. So let's say the house is worth 500 grand, and the seller will give you a mortgage for 400 grand at maybe like a 5% interest rate, right? You give them 100 grand. So if you have the cash, if you're going to put 20% down anyway, you might as well do it with the seller and then get a much lower interest rate, especially for investors. Because investors, your interest rate right now is well into the the sevens, high sevens. So if you can get a seller to finance you for 2 or 3, even 3 points less, it's a great way to get around the high interest rates.
And then obviously this is good for the buyers, but the benefits of the seller.
Well, the seller wants to sell their house, and so it's tough to sell a house right now. So if you, as a seller, as a buyer, you're going to pay for a house probably a little more than you would have to if you went through went it the other way. But a lot of homes right now they're not selling because sellers are trying to get a price that's not really realistic, and so or the market's dropped. And so the leverage is, okay, we still negotiate the price. We negotiate the price down, but maybe give a little more to get a much lower interest rate. And the seller can get cash because usually they need the cash for something. Seller gets cash from you, and you get the house at a much lower interest rate. With the idea being, of course, you're going to refinance it anyway within probably 3 years. So typically, seller financing is only going to last you a few years because usually they're going to do what's called a balloon, meaning that maybe it'll be a 30-year amortized mortgage, but they're going to want you to pay it off in 3 years. And so that means that gives you 3 years for rates to drop to refinance it. But it gets you into a house now at a much lower interest rate. Let's talk about what else we got. What other options do we have to defeat interest rates?
Assuming a loan that already exists.
Yeah. Okay. So assumption is the other part. So I was actually doing within a class this morning about assumption. Assuming loans is becoming a hotter topic right now. And so let's talk about the best ways of doing it. The by far best way to do an assumption is to assume a VA loan, which is a veteran's loan. So let's say someone bought a house VA in the last 9 months, right? Let's say they bought one in April, and if they bought it in April, they're probably upside down, quite frankly, because VA typically is very little money down, so maybe they put no money down at all, and the market's dropped 20%, so they're upside down. But they need to sell their house; they got to move. So what do? Yeah, one option would be to sell it to you You can sell a VA. You can sell a property to an investor, for example. An investor can actually assume the VA mortgage and take over, like maybe it's a 3% interest rate. It might be a very low rate. So an investor could take over that property. Maybe you pay the homeowner, some cash. If they're upside down, you pay them some cash to go away, basically, and you take over their mortgage. Or they can have equity. Let's say maybe they have $50,000 in equity in the property or $100,000 in equity in the property. But the market's so tough right now, it's hard to even extract your equity. So you could pay them the equity and take over a low interest rate. For investors, it's great. If you're putting 20% down on a house at, let's say, $400,000, you give a VA buyer $80,000 and take over a mortgage at 2.8% interest rate. You can do it, and you all have to qualify based on your ability to pay the mortgage. You do not need to be a veteran in order to take over a VA loan. Now, there's other options too. FHA loans can also be assumed. It's a little unclear if an investor can do it, but certainly an owner-occupied buyer can definitely do that. So if there's a FHA mortgage on a property, and you want to buy a house, say you want to buy your first house, or you want to buy a house, period, you can actually go and assume that FHA mortgage with the interest rate that's on the mortgage. The only downside to FHA, again, is like you got the mortgage insurance on there, which does not go away. So, but again, right now, honestly, compared to doing a 6% interest rate, it's, if you get to 3, even below 3, you're doing pretty well. And there's other options too. The subject to mortgages, we'll do a whole class on that one because that's complicated. But in theory, you could actually take over payments for a seller, for an owner as well, but it's more legally ambiguous there. So for today, I will focus on the best options, which are VA and FHA assumption.
Well,
all right.
Subject to is the last thing on our.
Oh, we can talk about subject to if you want. That's fine. You're in charge. We'll talk about it. So if you want to take over if somebody has a mortgage that's not FHA or VA, you cannot assume the mortgage. You can't assume it. They're not assumable. What you can do in theory, and there's some legal caveats, but you can buy the property from them and say, okay, I'll make your payments for you. Typically, they're going to want some cash up front for that honor. The previous owner is responsible for the mortgage payments. So they keep making the payment. You make the payments on their behalf, and you're good to go. I mean, you move on. You got the property, and so you can pick up a property that way for a lot less money out of pocket. In theory, I mean, it depends on their situation. And again, if they have a 3% or 3.5% interest rate, you could just pick up the property and continue making the payments, and now you got yourself a property. The downside to that is, again, the mortgage stays in the name of the previous owner. And the previous owner, if they mistakenly mention to the lender that they sold the house, or the lender finds out, they can call the mortgage due. And when they do that, you're essentially forced to refinance the house, or it goes into foreclosure. So if you do a subject to, you have to make sure you have the ability to refinance it later if it's required to do that by the lender. If the lender doesn't require it, then you just move on with your life and make the payments. If you're an investor and you can get the property and the interest rate and the mortgage payments are good enough to where you can make a cash flow on it, if that's what you want, then it's a good way to pick up properties. But there's risk involved there as well. But no matter what happens, you're going to own the property. It's just that if the loan gets called, then you have to go you have to refinance it or pay off the mortgage if you have the cash to do that.
So in subject to, you would go on the title. The buyer goes on the title. Yep. The mortgage stays in the previous owner's name. Yep. And then how would you make the payments?
You pay them like you would anything else. You pay the mortgage directly. Now there's risk to the seller because if you don't make the mortgage payments on time, it affects their credit, right? So you really have to find someone in the right situation to do subject to. I don't recommend it for everybody. I think it's better for investors because you got more of a tolerance level for the risk. But even investors, you gotta be ready for plan B. So if you have the ability to pay off that mortgage anytime, you might as well do it. If you have the ability to refinance it, you got the cash and the credit to do that, then there's not a whole lot of downside there. And there is risk for the seller, but that's the seller's problem to deal with that. So typically with that, you'd have an attorney involved to draft up the agreement to make sure everything it looks good as well. So it's more complicated, more legal risk, but it's a great way to pick up property with very little money out of pocket in theory. Like you can do it for as little as $20,000. I mean, maybe even less than that. Maybe not Vegas, but other markets you definitely could pick up property for less than that. And you may see more of that coming forward because people who are upside down, if the alternative is foreclosure or short sale or subject to, they're going to do subject to. And that's going to be, I think, the difference. And we didn't see subject to when the market dropped in 2008, 2009 because that was a market that was it wasn't rates were not higher, they were actually lower, right? So rates were actually lower when everything tanked. But now with rates being higher, there's more of a reason for an investor, for example, to want to do a subject to versus buying even a foreclosure where you have to go and get 8% or 7% interest rate as an investor. What do you think? Good?
That's good.
We covered everything?
I think so, yeah.
All right, so ask your questions and we will answer it below in the comments. And we got that done and nice and quick. And then we're going to try to do this every week. We'll do it again next week. Answer questions about what you guys, the big issues that we're seeing with our clients right now. And then, but ask your questions, what you want us to cover, and we will talk more about it next week.
Yeah, next week I think we have how to invest in a short-term rental.
Short-term rental, yeah, we do a lot of short-term rentals, so we'll talk about that on the 20th. And what do you want to add? Anything? No? All right. Sign off from the coffee class.